all of you. Today I'm going to present. I'll take a trial class of investment in securities market. So this class will be just an introductory class, and we'll just discuss what are the topics we have in this in the syllabus of ISM, and what are the syllabus we have in the so what are the topics do we have in the syllabus of ISM, and what is the basic, why was this course introduced in course was introduced in CVCS. So from last year itself we are following a new curriculum, that is CVCS. So in the CVCS we have this new subject has been introduced, and with the finance department we are going to take ISM. So this is just an introductory class. This is a trial class, as I mentioned earlier. So this I'm taking this class just to test the various tools. There's online applications which are available to take the class. So this subject will deal about what is how do we make investment, what are the objectives of investment, what are the methods of how a company raises money, then how do we find out in which stock or which financial security we must invest, and this is all about. And then we have mutual fund. In this course we will understand about mutual funds, and I think those who are from class last those who are attending those who have just passed class 12, they have got a brief touch of what is mutual fund, not in an elaborate way, but a brief touch. So here we are going to learn it in a elaborate way. Okay, so here we are going to learn in very elaborate way. So this in elaborate way, that what are mutual funds, how, in what are the composition, in what, how does what is mutual fund consist of, what does mutual fund do, and why it is necessary to invest in mutual fund, how it is good to investing in mutual fund rather than investing in stocks and bond. So this chapter is be all about. Then we'll understand about derivatives. Now with the now new financial securities have developed. In this new financial security, we can invest in commodities. We can invest in future. We can invest in gold. Then we can also we have also we can commodities, physical assets like gold, etc. Then we can invest in metals. So the commodities exchange, we can there are good number of financial instruments that has been developed, like derivatives, then like futures, like options, like swaps. All these are new innovative financial instrument which has been introduced in the financial market for the first time. So as we know that financial market is um, the financial market is the link between the savers and investors, and in financial market both the savers and investor come together. Savers invest Savers and investors. So savers, what to do, they in the households. Savers are basically households. Okay, basically they are savers are basically household, and investors are basically what, they are business firms. These savers, what they do, they save money. They save money, and then they save money, and they want a channel, an alternative channel to park their surplus money. Okay, so what? So savers, what they want, They park their surplus. Savers are what they have surplus funds, and they want to and channel to make an investment. And investors are the business firms who are in debt, who are in need of money because they want to make some investment they want to make modernization of plant, or they want to launch a new product, so they need money. So they, through this, in between these two, financial market acts as a chain, and gives a link, and it financial market acts as a link between savers and investors, and financial market mobilizes the savings from the households to the investors. Okay, so as we know, the savers, say here are the savers are the debtors, and investors are the creditors. Okay, so sorry, savers are the creditors and investors are the debtors. So what savers, what they do, they they have surplus funds, so they they invest in various securities like share, stock, bonds, and debentures, and the investors borrow money using these instruments. So this is how this works about. So financial market, as you know, that on the basis of on the basis of maturity, financial market has been divided into two. So as you can see, that money market and capital market. So the money market is what is the market which is less than 1 year. Means here the maturity period is less than 1 year. So here the instruments which are traded in money market are call money, then call money, treasury bills, certificate of deposits. All these are traded. All these securities are traded in money market. And who are the persons who deal in money market? Commercial banks, large corporates, state governments, Reserve Bank of India, then central government. All these persons trade in money market. In capital market, large corporates, individuals, and individuals any individual can go and invest in capital market, provided he has the knowledge of finance, or minimum knowledge of finance. So here are the based on the two, there are various securities which are available. So we'll see that. So investment is what? Investment is nothing but we are just sacrificing our present needs for our future gain. Okay, we want to purchase a home. So we do what? We save a little amount of money every year. So we are doing what? We are sacrificing our present needs for a later future goal. Okay, goal may be anything. It may be house, it may be purchasing a car, or it may be anything. So here what the objectives of the investment. First objectives of investment is minimization of risk. Okay, so more will be the risk, higher will be the return. Less will be the risk, lower will be the return. Okay, it applies that you can understand this like this. Suppose we are investing in a fixed deposit, the risk is less because we are getting a fixed amount of money like 7% or 6%, but we are getting a very low amount of return. Okay, so risk and return are always interlinked. Suppose the return is high, the risk will be more. Suppose equity, if you take the example of equity, so in equity, the investment and the return is very high. A 10 rupee stock can turn itself into a 1 lakh rupees stock. So the return is very high comparatively fixed deposit, but risk is also very high. Means 10 rupees may turn into zero also sometimes. So the risk is very high. The next is liquidity. Liquidity means how easily we can convert our investment into cash. Okay, so this means how easily we can convert our investment, how easily we can sell our investment and turn it into cash. That is known as liquidity. Okay, so these days the money market instruments are highly liquid because its maturity period is less than 1 year. We can easily go and sell our, like call money, whose lending period is one night. So after one night we'll get back the money, or maximum it is 7 days. Okay, so treasury bills also, the maximum the liquidity is 364, and it is highly secured because it is issued by the government of India on the behalf government RBI, issued by the RBI on the behalf of government of India. So these assets are highly liquid. Means if we want to sell, And stock also, nowadays when the online platform has been introduced, we can sell it at any time. Okay, you can sell it at any time. um, you can sell it at any time, and there is no problem in selling the investment. Means even if we want to sell it today, we can feed the amount with the current market price, we can feed it and we'll get back the money. Okay, this is very easy these days. So it's very easy these days to make investment. So next we come to the type of investment. What are the type of investment we have? Okay, so this is we can invest in either real assets or in financial assets. These are the two investment channels which are available. Two assets which are available for us to make investment. Okay. Mm, so these are the two. So these are the two investment channels which are available. So like real assets and tangible assets. Tangible assets is something which you can see, touch, and hear, and financial assets are like government securities, bonds, debenture, stock, mutual fund scheme. So real assets, we know that people who have surplus money, they invest in land, because land becomes a with the increasing the as the number of population is increasing, the value of the land is also getting day by day. Value of the land is also getting increased. Okay, so 1 acre land which purchase is for 1 lakh rupees, after 1 year or 2 year it may become 2 lakh rupees. Now building, if you own a building, you can put it, you can ask you can let it out and have earn the money to tenants. Okay, so you can ask the you can ask the tenant, and you can let it out. Then automobile, if you have, you can purchase it you can purchase cars, motorcycles, etc. So next category we have financial assets. So as I have mentioned, there are numerous financial assets can again be divided into money market instruments, capital market. So money market, as I mentioned, that treasury bills, call money, etc. Then certificate of deposits, repo, reverse repo, all this comes under commercial paper. All this comes under money market instrument. So the problem in money market instrument is that an individual like you and me cannot go and directly invest in money market. But for capital market, it is very easy to capital market is accessible to all the investors. Okay, like government securities. So government, from time to time, when there is shortfall in the revenue collection, government issues certain securities like treasury bills, etc. Then like treasury bills, like bonds. So bonds are just like debentures only. Bonds are issued by government, and generally it is secured. But the difference between bond and debenture is that bond is always issued at a discount to face value. but debentures are always issued at a face value. Okay, and they are the rate of interest in respect to bond are very less compared to the debentures. The debentures, all the means like big corporates, when they are in need of money and they want to borrow, raise cheap amount of money, instead of going into the stock primary market and raising funds, they can borrow the money through this debentures. So the maturity period of depending on the maturity period, and they will pay a fixed rate of interest. For example, it may be 10%, maybe 10. They may provide 10%, 20%, depending on their depending on the agreement. They may provide the interest. Okay, depending on the agreement, like a stock. And the difference between stock and share is that a lot of fully paid up share, a bundle of fully paid up share, a lot of fully paid up share is known as stock. And the share is something which is not fully paid up, but in case of the stock, it must be always fully paid up. Okay, and mm, share may be partly paid up, but stock is always fully paid up. Okay, the mutual fund scheme. There are the various mutual fund schemes, like depending on the risk appetite and depending on the investment, a person can invest in numerous. There are various mutual fund scheme like income oriented scheme, debt oriented scheme, tax saving scheme, equity link saving scheme, then gold ETFs. All these schemes are available for the investors to invest in mutual funds. So mutual fund provides the benefit of mutual fund scheme is that the person or the investor need not have to worry about taking worry about means, about his investment. It is done by the fund manager. So there is a professional fund manager who looks into the corpus of the funds, and it is managed. He decides where to invest, what will be the asset portfolio allocation, what will be the portfolio, where what will be in which class of securities they are going to invest. It is all done by the asset management company. Okay, it is all done by the AMC, which is short form is known as AMC. AMC stands for asset management company. Okay, so it is looked after. The mutual fund is very beneficial for investors who do not have the know-how to investment in securities market. Okay, so who do not have the knowledge of securities market. So mutual fund scheme is very beneficial for them. And there is another category, the life insurance schemes. So people who want to life insurance provides very good amount of return on survival or on maturity, on death or maturity, and it also acts as a risk mitigation tool. The life insurance scheme, and where you can depending on the nature of the scheme, you have to contribute a small amount of money to the to that part to the particular scheme, and at the end of the tenure you will get a lump sum amount of money. Okay, so this is all about this is brief introductory class which I have taken today. So thank you very much. Hope to meet you tomorrow. So with this, I end today's class. Thank you.